right, let's bring you a fresh global perspective now. We're joined on the show by Gary Antonacci. He has been an investment professional for 40 years. He's also an award-winning author for his work when it comes to dual momentum investing. Gary, thanks so much for joining us. And it's a unique principle, that you have really approached the market with. Talk to us a little bit about the approach. Tell us about, what it really entails, what's unique about it.
Dual momentum makes use of two things. The first is relative strength momentum, where you compare the performance of one asset to other assets. And the other is absolute momentum, where you look at the asset performance with respect to itself over time. So dual momentum combines both of those together. An example would be if we are deciding whether to be in stocks or not, we might look at the U.S. stock market and see if it's been going up or down over the past year. If it's been going up, we say that absolute momentum or time series momentum is positive, and we want to be in stocks because momentum means persistence in performance. And then once we know we want to be in stocks, then we have to decide which ones. And there we compare the U.S. stock market to other markets, and the way I apply it is to apply it to an aggregate of the rest of the world. So I use the MSCI All Country World Index ex-US, and whichever of those two has been stronger over the past year is the one that I invest in. You can apply dual momentum in many ways to alternative investments and other markets as well.
Right. Gary, how is it that you're applying it to the current scenario, for example, with the current trend in the US equities, and what would be the strategy that you recommend?
Well, right now, everything is looking good. Late last year, there were some uncertainties given the economic scenario with respect to trade policies and possible leading economic indicators that were weakening, as well as the Federal Reserve here seeming like they were tightening. But now everything is in a positive direction once again. So all of the trends are positive, and we're fully invested.
Okay, so share with us examples of themes that perhaps you're applying the momentum theory to, and where is it that you've seen it show success?
The way it's usually applied is to portfolios of individual stocks. And there are a number of exchange-traded funds and mutual funds that are set up to do that. However, that's not the best way to use momentum. Research has shown that momentum works best when it's applied to geographically diversified stock indices. That gets rid of a lot of the noise, the idiosyncratic volatility, and so forth, and allows the pure trends to be identified and exploited better. So some people will apply it to sectors of different markets, some to style variations, and I find it works well just applied to broad market indices themselves. So like I say, I apply it to the U.S. market and the rest of the world. Keep it very simple that way.
Okay, so when we're talking about the global scenario, Gary, do you foresee any rotation from DMs towards EMs? Where do you see leadership emerge from?
The DMs have been pretty strong. And that has to do with market strength because they are more volatile. So when you have strong performing markets, you'd expect EMs to outperform developed markets, but there's also growth factors that come in. The Sensex has been particularly strong. It's made new highs this month, just like the U.S. market has, and so you have to look at what's going on throughout the world as well to gain some sense of that. So I include both. I use all countries. When I'm outside of the U.S., I'll include both DMs and EMs because EMs by themselves can be very volatile. So I like to have both together.
Okay, so within EMs then, your view on India, given that the recent rally has been on the back of strong foreign flows, do you believe it will sustain going forward?
Well, India has, the fastest growing economy in the world. and it's projected to be the third largest economy ever. So I can see that continuation. I don't see any reason why it couldn't happen. Trade policies from this country can complicate things, and we're all waiting to see how that gets resolved. But assuming that everything goes ahead as it looks to be going ahead, the markets are telling us that everything seems positive. I see no reason why India and other parts of the world can't continue to do well.
Right. Gary, recently the inverted yield curve in the US was much spoken about and in the past has led to recession in the economy as well. What is it that you're predicting this time and your own outlook on bonds in the current macro context?
Well, bonds are looking positive now. The Federal Reserve here late last year was giving indications of tightening, and now they've gone back on that policy. So the bond market has been responding well. I actually look at a number of different sub areas. I look at U.S. markets, non-U.S. markets, gold, oil, foreign bonds, and U.S. bonds. And the only area that's weak right now would be non-U.S. bonds, but that's on a short-term temporary basis. I think going forward, the yield curve is not inverted anymore, and even if it were, the recession doesn't happen for at least 7 months, sometimes 2 or 3 years. The average is about 16 months after a yield curve inversion. And employment is looking better. Employment numbers are good here, as well as in India. And GDP growth looks decent. So I don't have any concerns at the present time.
Fantastic, Gary. Always good to hear, especially when we are counting down to hear, what the Fed does next, later on this week. Thanks so much for joining us.